Welcome to the Market Pulse, Marex's podcast on the markets we operate in, the asset classes we trade, and the regulatory changes that affect them. For those who are new here, Marex is a diversified global financial services platform providing access across energy, commodities, and financial markets, with services including market making, clearing, hedging and investment solutions, and capital markets. As a quick disclaimer, and so it's clear, we are wanting to comment specifically on the markets and not focusing or intending to comment on politics. In today's first episode of the Market Pulse, we're joined by Sasha Foss, Energy Market Analyst at CSC Commodities, a division of Marex. Thanks so much for joining us, Sasha.
Thank you for having me, Venus.
So we're only a month into 2026 and there's already been so much volatility in the market. Could you give us just a brief breakdown on what we're seeing?
Yes, well, so far we've had three seismic political events in January 2026, which have really woken the market up from its slumber that it ended 2025 with. So first of all, we had the arrest of Nicolas Maduro, the Venezuelan president. Venezuela has the world's largest proven crude oil reserves at 300 billion barrels. So it's an important player within the oil market. Secondly, we've had mass civil unrest in Iran, which threatens a regime change in one of the world's largest oil producers and with the third largest proven crude reserves in the world. And thirdly, in a more nuanced picture, we've had a kind of disagreement amongst allies with renewed US coveting of Greenland, wanting to acquire it from its NATO ally Denmark. And these narratives have really shifted the sentiment in the market away from maybe a supply gut and physical fundamentals to adding a kind of geopolitical risk premium. So when we ended the year, Brent crude futures, the front month was around $60 per barrel, and already we've seen it breaking through $70 per barrel, despite a kind of unanimous consensus in the market that we would see crude prices decline to around the mid-50s, say.
And if we're to take it back to that kind of first point that you made around Venezuela, how significant were those events to the oil market?
It's also a little bit nuanced that Venezuela, because it has the world's largest crude reserves, it's a massive country in terms of the global oil market. But when we look at production, actually Venezuela, due to sanctions and kind of maybe decades of misrule, actually was only producing 900,000 barrels per day, 1 million barrels per day. Right. So that represents about 1% of the oil market. So currently it's not a systemic player, but what we could see further down the curve is if the US kind of picks these low-hanging fruit in Venezuela through investment and pumping up production and also a rearranging of the oil flows, we could see actually quite bearish sentiment affecting the oil market. But one thing that is quite important in terms of the nature of Venezuela's crude is that it's a very heavy, sour product. So it affects... It needs a kind of diluent. So the US is now going to import naphtha into Venezuela, which will replace Russian naphtha. Also, in terms of exports, the Venezuelan crude will now enter US Gulf Coast refineries, which were built specifically for this kind of heavy crude, which are historically received from Venezuela, but also Canada, and it can transform this kind of cheaper, more difficult to refine crude into very high value products such as diesel and gasoline. And actually this investment in these kind of complex refineries in the US Gulf Coast happened right before the advent of the shale revolution, which is very light, sweet crude oil. So the US refineries prefer to take this heavy oil and actually export the lighter sweet into the global market. So in terms of rearrangement of flows and also the nature of crude, we can see that Venezuela will become a very important factor in global crude markets. And in terms of when we look at supply diversification, Canada, which used to send most of its exports to America, it's recently opened up the TMX pipeline, and there are even plans to expand it and add new pipelines from Alberta to the Pacific coast of Canada, which will allow Canada to export its crude to Asia. We've already seen China, independent refiners buying this Canadian heavy crude. So we see a diversification of supply channels. affecting this oil market.
And just to stay on the topic of Venezuela, it feels like it has both bullish and bearish sentiments for the oil market. So in contrast, it feels like there's saber rattling between Iran and US, which is a little bit more clear cut to the oil market. Is that correct?
Yes, exactly. That's definitely correct. So Iran's much more prominent in terms of a producer currently. If you include condensates and natural gas liquids, Iranian production can be around 5 million barrels per day. So essentially 5% of the oil market. So it's more important than Venezuela in the current spot market. So if there is regime change or labor strikes, as happened in the 1979 Iranian Revolution, then production will immediately be impacted, and it will be very bullish for global oil prices. So we see oil options, it's much more clear cut in terms of puts and calls, in terms of what people are trading in the market.
The third event that you talked over, Greenland, not an oil producing nation, how will this affect oil markets? It seems a little bit less obvious than the other two.
So the Greenland situation is nuanced in terms of it doesn't produce any oil because of environmental regulations. We wouldn't expect it to become a major oil producing nation anytime soon. However, it affects the politics of the oil market in terms of a kind of disagreement between allies, between NATO allies, the US and Denmark. And we saw that there were threats of tariffs from the US to Europe, but also counter tariffs from Europe to the US. And this would really affect trade, which is massively correlated with oil demand. So it would be quite bearish in terms of oil demand if we saw any reduction in trade between Europe and the US.
And of course, CSC Commodities, a division of Marex, operates across the energy complex as well as freight and environmental products. Can you give us a little bit of insight in how it's had a bit of a ripple effect on some of those products as well?
The energy complex is obviously very intertwined, interrelated. So any big moves in the oil market will inevitably affect environmental and freight markets. So if we turn back to the geopolitics involved, we see that the key choke points of supply, for example, the Strait of Hormuz in Iran, if there were any escalation in the conflict between the US and Iran, there could be potential mining or the closure of the Strait of Hormuz, which represents around 20% of global oil trade. So freight markets would very much explode and move upwards. We saw that over the last few years with Houthi strikes in the Red Sea affecting freight markets, where we see the big cargo and oil product ships transiting or around the Cape of Good Hope, which has kind of elongated supply routes. So more miles are being transited, which has an upward pressure on freight markets, but also, say, fuel oil, which is used to supply the ships. And in terms of environmental, we see that the new US administration is more skeptical, and we've seen some delays, for example, to the IMO reduction in sulfur content in the Atlantic basin, and we've seen a shift in tones in terms of policy. But here at CSC, we're very engaged, for example, in the CORSIA, the emission credits for the aviation sector. We have direct relationships with that.
Thanks so much, Sasha, for your insights. That's been really, really useful.
Thank you, Venus.
This concludes our first Market Pulse episode. In our next episode, we will be joined by CSC's environmental team, discussing some of the key challenges and strategies for procurement in the CORSIA carbon market. Join us then.